I am Nick Hodge. I am without my partner this week, Mr. Gerardo Del Real. He's off on vacation watching the Cubs play. So I have a colleague and friend of ours that we've spent some time with over the past several years in the gold and silver space, Mr. David Erfle. How are you?
Good, Nick. Great. Thanks for having me on. Nice to be with you.
Absolutely. I'm surprised we haven't had you on before. You write the Junior Mining Junky, and you also write a weekly column for Kitco, I believe it is, that I get
Correct.
in my inbox every Friday evening that I always enjoy reading. That covers all the topics as it relates to the precious metals, interest rates, technical levels, what the central banks are doing. So
Mm-hmm.
you want to give us a little bit of background and tell us how you spend your days?
Sure. Yeah. I got into this sector about 20 years ago, under similar circumstances, where we had raging bull markets in equities, but this was after the dot-com bust, and I was looking for a sector that was going up while everything else was going down, and I came upon the mining space, and I just fell in love with it in 2003, and I've been in it ever since. And I started a newsletter in April of 2017 after beginning to write a weekly column for Kitco in 2016. I got a lot of interest from people that were reading my column saying, hey, you should do a newsletter. I'll subscribe. So I did, and it's doing really well. And I keep my subscribers up to date on a weekly basis, covering macroeconomics, anything that affects the gold and silver price I cover. And basically, it's your one-stop shop for anything you need to know that's going on in the precious metal sector each week.
Great. I love to read the column. Like I say, when it comes out, it informs me of many things that are going on. And one of the things I like about your letter, although I'm not a subscriber, I sort of know the premise behind it. It's what you're doing with your own money. It's what you're
Correct.
buying and selling in the junior mining space, and that's what Gerardo and I write about as well. We have skin in the game, and people either like that or they hate it. But I think you should like it if you're an investor, because we're in the pool with you. If we're not making money, then the reader's not making money, and that's how you do it, right?
Absolutely. I mean, I ask the same of the juniors that I invest in. If they don't have their own skin in the game and they're not participating in private placements, and all they have is just a bunch of cheap founder shares and options, then why should I invest in their company if they're not gambling on it as well?
That's right. Share structure and people and skin in the game. Those are some of the top three metrics for sure.
Mm-hmm.
Before we get to the evaluation of junior mining companies, let's start a little higher, if you will. Let's talk about the gold price, where we've been and where you think we're going. So just a little summary. We ran over $2,000 in May. Since then, the Fed has resumed its hawkish posture. The interest rates have ticked up a little bit, particularly on the 10-year yield here of late. And this recession keeps getting sort of delayed. So from your chair over there in California, I believe it is, where do you think we are in the gold cycle? Are we bullish? Are we bearish? What are the technical levels you're watching? So sort of that sort of stuff.
It's a really interesting situation that's taken place in the sector for the past several years. If you take a step back and you look at a big picture chart of the gold price over the past 20 years, it's got this beautiful cup and handle pattern. It looks like it's ready to break out. And then you look at the gold stocks, and especially the juniors, and they continue to go lower in relation to the price of gold. And nobody's cares about this sector. Is basically all the generalists left in 2013 when the gold price lost 1550 and started a bear market. So where we are right now, though, is that 2100 level in the gold price has been resistance going back over 12 years. And it reminds me of when I got into this sector earlier in this conversation, when I told you in 2003, the gold price was bumping up against 475, 500. 500 was that Maginot line that it couldn't get above. And it had formed a cup and handle, similar cup and handle chart pattern, which is the most bullish technical chart pattern you can ask for under the $500 gold price. And once the $500 gold price was broken out, when you had a $500 close on a monthly basis, that's when gold took off. The sector took off, the stocks took off, everything took off. And then you got up to the $1,000 level, which is another round number that gold was stopping at. And as soon as it hit 1,000, it backed off because it had made this huge run, and it tested that level a few times, and then it finally broke out a monthly close above 1,000. But that only took a year, and we had the blow off move to 1925. Never got over 2,000. We had everybody saying that gold was going to 2,000. It was a given. When you start hearing that, it's not going to happen, and it didn't happen. So now recently, it's that $2,000 level again. That's been really strong resistance. We've climbed above it a few times. We've had 3 tries, and typically in markets, you have 3 tries at a major long-term resistance, multi-year resistance level. And the third attempt usually fails, and it failed again here recently. But what gold tends to do before it has a major breakout, it has a false move in the opposite direction that it intends to break out first. This happened late last year at 1675. 1675 was a strong base going back for the last few years. And everybody was saying that, hey, 1675 breaks, stops are going to get run. Gold's going to go down to 1,400, 1,500, easy. That's a given. Well, of course, that didn't happen. It turned out to be a false breakout to the downside. And whenever you have a false breakout to the downside or the upside, the opposite move in the direction of its intended move happens really quickly. It did happen very quickly. We had a 465 move from 1620. From a triple bottom at 1620 in November.
Straight up. Yep.
So we had a $465 move to test the all-time high, $4 below the all-time high at 2085 in gold futures. 2089 is the all-time high, right? So a 38.2 retracement from that is just above 1900. It tested just above 1900 today, right? And what was yesterday? Options expiration on the COMEX, right? It's funny how these things always bottom or top around COMEX OPEX days. Today was first notice of delivery, and tomorrow, of course, we have the Q2 close. So the first half of the year will end. You're having all this book square right now. We had an intraday reversal in the gold stocks today from major support levels after being extreme oversold on a daily basis. So that's where we are right now. We're at a juncture where I believe this is just another false move before the gold price breaks out. The number to watch is a monthly close above 2,000. We're not going to get that tomorrow, but we could get it in July.
Well, you took my next question. I was going to ask you how important the monthly close was, and particularly the quarterly close as well. Where do you think the downside support is? If we don't get the monthly close tomorrow, do you think we go down below 1900 and test resistance somewhere in the 1800s?
The only thing that would worry me is if we had a monthly close below 1870 tomorrow, and I don't see that happening.
Gotcha.
That would be a $50 move lower tomorrow. And but the next support level below this 1900 level is 1850. That's the 50% retracement level of that $465 move. And it's also longer term support in the gold price. I don't see that happening, but it could very easily take place.
So those are the technicals. Let's get into the fundamentals of gold for a little bit. Lots of things floating around there, right? Lots of gold bug stories are always in the mix. Lots of talk about de-dollarization, which gets exaggerated a bit, but is a real storyline, I think, as it relates to China and Russia and that part of the world, particularly how China deals with Australia and their very large trade partners. They could cut out the U.S. dollar if they wanted. What are the fundamental? And then I guess to add to the mix, you've had significant central bank buying, record buying in 2022,
right?
Record first quarter buying by central banks. And so where do those sort of fundamentals come into play for you, and how do you view them, and what are you watching?
Yeah, it's the central bank buying, Nick, that's kept the gold price where it is, despite all these outside forces trying to keep it lower. I mean, if you take a look at the U.S. dollar index, the first time gold went above $2,000 in August of 2020, the DXY was at 94.
Mm.
Okay. And now the DXY is over 102, and critical support is at 100, even though the gold price is just a couple $100 away from all-time highs. So if you take a look at the central bank buying, that has been key, but it's investor demand that has not kept up with that central bank buying, right? So you have smart money, the Eastern central banks, de-dollarizing and going into gold, especially China, selling their U.S. treasuries to buy gold. That's huge. And but the investor hasn't the investment it hasn't caught up with that yet. The ETF demand is still pretty low. So, and I think that's because the stock market continues to go higher. I mean, if you see these ridiculous valuations of the magnificent 7 stocks that all these people are talking about, Nvidia with a PE ratio over 200, and going up nearly 200% in the past 6 months. And basically, if you take Nvidia, if you take Apple and Microsoft, those 2 stocks alone represent 15% of the entire S&P right now. So,
Mm-hmm.
You've got these bubble valuations in these 7 stocks keeping the stock market elevated, and the gold price, going sideways to nowhere for the past 3 years. People are just giving up on their gold stocks if they hold them, and they're selling them for tax loss. And a couple of weeks ago, we even had a big seller in gold stocks leave the market in Van Eck, who rebalanced both GDXJ and SILJ. And the GDXJ stocks was noticeable, but it was really noticeable on the silver juniors. It's a smaller market, and when they rebalanced out of their smaller silver juniors, it really hit them hard. So basically, we need to get investor demand back. We need to get investors excited about gold again, and I don't think that's going to happen until the gold price breaks out. And the gold price will not technically break out until we see a monthly close above $2,100 an ounce.
Well, it's sort of chicken and egg, right? And I've heard this a lot. Gold needs to go up to get investors excited, but investors aren't excited, so they're not buying gold, so gold can't go up. So how do we close the loop on that insanity? I guess back to this de-dollarization for a second. If you've got China selling all these treasuries, and you've got China perhaps looking to skirt the dollar and trade with some of its partners in yuan. And you've certainly got, Russia selling commodities for gold in some way, oil particularly, and then turning currencies into gold. When people talk about de-dollarization, it's very esoteric, right? What does that even fucking mean? But really what it means is, what do you do with those dollars? Like, an example I was reading this week was, Australia sends a ton of ore to China to be processed, right? Because China's got a stranglehold on all the processing for lots of materials. So let's say China says, you've got to buy this from us in yuan, or we've got to sell this to you. And one of these countries, like Australia, has a lot of Chinese currency sitting around. Well, what can they do with that? One of the things they can do, because it's not like they can trade with other people in that, but one thing they can do is buy the age-old currency, right? They can buy gold. And so do you see sort of that happening, or what other catalysts do you see that could close that loop that we were just talking about?
I do, but and a lot of people are continuing to look at the Fed. They hinge the gold price on what the Fed is going to do and what the Fed says it's going to do. That's not really what moves the gold price the most. What moves the gold price the most in the past has been war and the loss of faith in government. So, it's unfortunately, this war in Europe continues to escalate, and these tensions with U.S. and China continue to escalate. If I'm China and the U.S. continues to be aggressive, with these tariffs and things of that nature, and they're moving towards war and all these other places. I'm gonna get rid of my U.S. treasuries, and China, they announced their gold holdings, but you and I both know that they've probably got a lot more gold than they say they have. So, unfortunately, I think the catalyst to break the gold price out might be an escalation of war in Europe. I mean, we had a failed coup happen over the weekend that was dissolved rather quickly, and by the time gold opened, the situation was under control already, so the gold price really wasn't affected. But I mean, that war continues to move on, and we continue to send money over there. And NATO has, they just got through finishing these air war games that involved 10,000 troops in 25 countries, so I think the war card will eventually break the gold price out. Unfortunately, I don't want that to happen. But if you want a comparison, if we take a look at what happened back in the 70s, the Fed was beginning to raise interest rates again in 1975 after the gold price had been cut in half from $200 down to about $100. And it started to raise rates from 4% as the Fed was obviously losing control of inflation. Stagflation was the buzzword, and the recession was really bad, and the gold price went up along with the Fed raising rates. The Fed started raising at 4% and didn't finish until they got to 20%. But what people don't understand is that the gold price tripled by the time they got to around 18% on the interest rate to around $400. The gold sector went into blow-off mode when Russia went into Afghanistan, and we had the Iran hostage crisis in late 1979. That is what was the catalyst to double the gold price again from a little over $400 to $850 by January of 1980, and that was the blow-off. So, once the gold breaks out, this price breaks out this time, I don't expect it to be a blow-off, because if you take a look at the chart, it's got that 12-year cup and handle, and once it breaks out, the first target is $3,000 an ounce. So, with everything that's going on macroeconomically and geopolitically, I think it's only a matter of time before the gold price breaks out.
You mentioned the dollar and gold going up quasi alongside it. I too have noticed the inverse correlation, not meaning as much there. I do watch interest rates a little bit closer than I watch the dollar, particularly the longer term interest rates, the 10-year and the 30-year, because they're controlled more by the economy, whereas the shorter end of the curve, the 2-year, is controlled more by what the Fed is doing. And everybody has been saying, pivot, they're going to pivot. They've been saying that for over a year. And I've been saying, look, this Fed isn't going to pivot. This guy Powell he's on a mission.
Until they're forced to, until they create a crisis.
And so this is where I'm going next, right? The recession has been kicked down the road. The yield curve has been inverted for a long time now. It continues to steepen. In fact, it's inverted by more than 1.0% now here in the past couple of days. And we'll see what GDP says. It comes out on July 27th for the Q2. It's not going to be negative. It might have a zero handle on it, but I don't think it's going to have a negative handle on it. And so that pushes recession out until Q3, Q4, maybe Q1 next year. And so what I'm looking at is a recession that doesn't materialize for another several quarters. And that's this is just my thesis now, take unemployment to a level that's going to force the Fed's hand. And they're going to say, you know what, we're not going to be able to get to 2% inflation. Maybe 3 or 4% is okay. And now we have to pause or potentially even cut because the unemployment is mounting. And so what are your thoughts on that recession timeline? And I guess any thoughts or knowledge you have about how gold acts in a recession? Because we can think back to 2008 and say, gold didn't go up in 2008 to even 2009. It wasn't until they really started cutting rates after that. And of course, gold hit a record after that, right?
Well, it was basically the Fed recapitalizing the banking system. That was the all clear for gold to rise. And of course, when it did that, it had that false move down to around $600, and then it just slingshotted up higher, way above 1,000, and eventually got to 1,900. But I digress as far as what the question was. If the thing to really pay attention to, Nick, here, I think is the 2-year yield. The Fed generally follows the 2-year yield with their Fed funds rate, and the 2-year yield now is about 4.7. And the first time the most recently, the 2-year yield went up to 5%. Back at the beginning of March, and that created the regional banking crisis. And of course, the Fed had to flood the market with liquidity, flood the banking system with some liquidity to put out some fires. And the gold price moved up to $2,000 again. And before that, in 2008, the 2-year yield got to 5% right before the global financial crisis. That's what triggered the global financial crisis. So, all this debt in the system, when you combine it with the Fed having its most aggressive rate hike campaign since the 1980s, 500 basis points in 14 months. I mean, they're just waiting for the next. The next black swan that they're trying to create. I mean, they're basically trying to create a recession. You hear them talking about it, and
there will be pain. There will be pain, he said several months
exactly.
ago.
There will be pain. And did you hear what he said just this week at that economic conference in Europe? When he basically flat out came out and said, we don't expect inflation to get down to our 2% target until 2025. Okay, so if the Fed goes ahead and raises another quarter basis point in 4 weeks at the end of July, like the market is pricing in 85% chance now, the 2-year yield is going to rise to 5% and create another crisis. And then the Fed's general policy is basically, look, we're gonna raise rates until we break something again.
And is that bullish for gold?
Yes, absolutely, it's bullish for gold. I mean, you want to see the gold price go up for economic reasons as opposed to geopolitical reasons.
Yes.
I mean, before the recent rise to 2,000, right? Gold price went up last year to 2,000 on the back of Russia going into Ukraine. And the U.S. dollar and gold were rising together as a safe haven. When that turned out to be just a regional war and it didn't escalate into other countries, the gold price came back down. And now we are where we are. So, you never want to see the gold price break out on geopolitical reasons. But like I said, I think that might be the reason it does break out here in the not too distant future because of what's going on over in Europe.
Let's move to gold stocks now, which are not gold. And I have to continuously remind people of that.
Yes.
Because you had gold at 2000 and yet the gold equities haven't kept pace. If you look
right.
at, the leverage they should have relative to gold and that they've shown in previous cycles, they're not showing that, whether it's the royalty companies, the producers, or the juniors. So talk to me about what you're seeing in GDX and GDXJ terms, and then maybe we'll talk about the junior space for a little bit.
Yeah, it's been my argument for ever since late last year that the gold stocks bottomed in September of 2022, and their typical 7-year gold stock cycle low. I mean, every 7 years the gold stocks have a major bottom. There was since the secular bull market in gold began, when gold double bottomed at 250 back in 2001. We had a major bottom in 2001 in gold stocks. We had a major bottom in 2008 in gold stocks, the global financial crisis. And then in late 2015, we had another major bottom in gold stocks. And then September 2022, that was 7 years later, and the GDX and GDXJ are still trading, believe it or not, 40% off of those lows. They've made higher highs and higher lows. Both GDX and GDXJ are attempting to make a higher low at 30 and 35 respectively here as we're speaking. There's an open gap at 28 created from the regional banking crisis in the beginning of March that could fill first. Judging by the hammer today, as we go into the last day of the quarter end book scoring, and going into the second half of the year, I expect a big move in the gold price next week. But it's going to be vacation central basically next week. Most everybody's going to be on vacation. It's going to be a short week. There's a holiday in the U.S. on Tuesday. But as far as the juniors are concerned, a lot of them continue to go lower. Like I said, we had a big seller leave the market a couple weeks ago in Van Eck when we had those rebalancings. And basically my portfolio, which is, my junior portfolio, is up on the week despite the sector being down because of this, because most of that selling came from Van Eck a couple weeks ago, and there was also related selling from other companies where people that didn't know about the rebalance, and most didn't. They're just like, forget it. I'm done with these gold stock, selling it for tax loss, and I'm putting it into the stock market.
Yeah.
So we've had a lot of this take place in this sector, because if you take a look at the selling, whenever we have a peak, ever since the major bottom of September last year, whenever we had a peak, the consolidation of the move comes on lower and lower volume. If you take a look at the volume, it continues to dwindle and dwindle and dwindle. And if you take a look at the volume on the TSX, it's the lowest it's been in over 20 years.
Wow.
So the volume hasn't been this low since gold was trading below $300 an ounce, and nobody cared about gold stocks. So we're at that point again where the generalist left in 2013 and has yet to return. But basically since 2015, we've had 2 6-month bull markets and 2 3-year bear markets following the 6-month bull markets in gold stocks.
When I look back at the last couple of times gold was above 2,000, it took many fewer shares of the GDX and GDXJ to buy 1 ounce of gold. And I'm not a huge ratio guy, but I'm smart enough to know that it takes many more shares of GDX and GDXJ to buy 1 ounce of gold right now. And I wonder what might change that. You've seen some acquisitions, not huge ones. Well, you had Newmont and Newcrest, but you haven't seen a lot on the smaller end of the spectrum. We all know these producers have to refill their coffers. Outside of gold firmly breaking through 2,000, what do you see as things or catalysts that could attract investors back to gold stocks, or that could see them revalued higher?
Yeah, well, the stock market needs to roll over. That's one big thing
that's actually a good point. You said the generalist investor left and has gone back into the stock market. I think the generalist investor has been sucked into a bear market rally that's gone on here for the past several months, and I still think we're in a broad bear market for the stock market indices,
except for those 7 stocks.
Exactly right. And that once this recession does materialize, that we will have that rolling over. So I guess I tend to agree with you in that respect. And so I've been positioning aggressively both in gold and gold equities, right? Wrote some checks late last year and early this year into private placements. And I'm happy to talk about some of those companies. But I wanted to give you the opportunity to talk about maybe exploration programs you're excited about. We're getting here into the drilling season in some locations. And just wanted, not that you got to give away all your picks, of course, but I was just wondering if there's anything you're really excited about.
Well, Nick, it's funny. Not funny, but it's just a fact of the market. I've avoided drill plays for quite some time now.
Okay.
Because basically with the generalist out of the market and most interest really waning in the sector, even good news gets sold. And you really have to watch. I mean, I'm only invested now in 2 companies that are getting close to PEA stage. Everything else I'm invested in is a later stage.
Gotcha. Like
so
developers.
I'm not going to get back into earlier stage drill plays until the sector gets back into a bull market again. Because basically, I'm not willing to risk my capital on something that that companies are expecting to find, when I can invest in companies that have already found it. They found multi-million ounces in the ground in top jurisdictions. They've got great management teams. They know when to raise money. They have access to capital. They can, some of them can even raise money without a warrant, even in this environment, which I've seen recently. So I'm going to invest in those. I'm invested in those companies until this market turns.
That's interesting. I invest across the spectrum. I own royalty companies. I own producers. But I've tended to also gravitate to the developers over the years. I believe you and I met on a tour for a company that is called Revival Gold that has it's a past producer, it's a brownfield site, it's got infrastructure, it has a resource, it has a PEA, they're working on a PFS, and
I'm an investor. Yes,
that's just for the early part of it. So there's one name right there, but then I spend a lot of time looking at and buying shares in companies like Artemis. And I look a lot at the G-Min mining, and like you say, these are companies that have raised the capital, and I think about the Lassonde curve, which investors I think tend to forget about too often, right? Maybe any thoughts you have on the Lassonde curve, why it's good to get in a company when they're building a mine or past the economic study stage, and again, any names that you'd like to share, we'd be happy to hear on.
Yeah, well, basically, it's less risky right now. You know, we're in a very high risk sector here. This is high risk, high reward, right? So, in an environment like this, it just makes more sense to me to invest in these companies, even if I'm a little bit early in the Lassonde curve. I don't mind, because I know that mine's going to get built. I know it has high margins, and I know that M&A is going to pick up again here pretty soon. It has to. So these companies, they got to replace their ounces. And if you get into the companies that have done it right, you know, without having to dilute their shareholders too much, then and there's still upside there, then that's what makes the most sense to me. Like I said, there's two companies that I'm invested in that are getting close to the PE stage, but both of them have around 50 million in cash. So, you know, if you are going to speculate in these drill plays, you got to make sure that they have enough cash well into next year, because recently the financing window closed again. And if you didn't finance, then I don't care how good your project is, I don't care how great your drill results are, the stock is going to get sold as soon as that news release it comes out with bonanza grade results, even if they're lucky enough to get bonanza grade results, because the smart money that's left in this sector is basically saying, wow, great project, but they're going to need money in 6 to 8 months or even 4 months. So I'm going to sell the stock and wait for the private placement, because I know I can get it cheaper, and I can get either a half or a full warrant also to boot.
Yep. How much does jurisdiction matter to you?
It matters a lot. It really does. I mean, especially now, because you don't have to take chances on riskier companies that are de-risking projects in tier 3 jurisdictions or tier 2 jurisdictions. You know, I have a couple companies in tier 2 jurisdictions, but I know that they're safe because I know the company, the government wants mining. And it's some of these West African countries, you know, you can get a mine built really quickly, you can get it permitted really quickly, and they're trading at even a bigger discount than gold in the ground in tier 1 jurisdictions right now. So jurisdiction is key. If you take a look at something that recently happened to Calibre, where the countries was put on a sanction list because they thought that gold was being used for terrorist reasons. They put sanctions on the country. You know, the stock was hit really hard. That's a great company. You know, they're doing a really good job of building a growth-oriented producer, and they added another project in Nevada to dissuade that risk. But, you know, I mean, you have to spread out your risk in this sector. You know, I don't put any more than 4 or 5% of my investment capital into one company, because voice of experience here, even the companies that look like they're going to be the biggest home runs. Oh, wow, look at this. It ticks all the boxes, right? That's usually the one that you end up having something come out of left field and screw you up on. But, that's why, you just have to diversify within this sector. And you have to buy in times like these when the more it hurts, the pain in your gut that you get, the tougher it is to hit that buy button. That's usually the best time to buy. You have to buy fishing lines and sell rhino horns in this sector, or you're not going to be playing in this sector for very long.
I find myself looking at Calibre too. I know those guys and tended to stay away from it because of Nicaragua. But you mentioned the asset that they picked up in Nevada. I've been to the Pan mine. I helped them raise a bit of money when they were still private as GRP Minerals, even before it was Fiore. And so not only do they have the asset in Nevada, they've got some exploration plays that have resources on them, including one near where I live, up in Spokane, Washington, the Golden Eagle, I think it's called. So I tend to look at that one as well.
I had to sell it because that you never know what's going to happen there now. I mean, they could cut if this escalation heats up between Ukraine and Russia, and U.S. gets more involved. They could say, what, we forbid you to trade in companies in Nicaragua now. That's a very real possibility. So I hated to sell the stock when that happened. It was in my top 10. I had a lot of high hopes for it. But it is what it is. 65% of my investor base are U.S. investors.
I want to start to wrap up here, and I appreciate your time. The one thing we haven't spoken about is silver. So maybe we can wrap up with your thoughts about the other precious metal that also has some industrial uses.
Yeah, that's the thing about silver, right? You never know when that industrial component is going to rear its ugly head and hit the price. But recently, the sentiment in silver is in the toilet. It's I think the DSI hit single digits this week. So, and if you take a look at that 22 level, that's been really solid support for a while. And 21 level is basically uptrend line support. So I look for silver to start silver's already started to turn a little bit here. It's starting to show relative strength to the gold price, but until we have the gold silver ratio back below that 80 level, then I don't see silver doing very much until that happens. It's getting closer. It's getting down there again. 80 to 1 has proven to be a key level to watch on that gold silver ratio. When it starts trending below 80, and silver is leading gold along with the mining stocks, because basically the mining stocks and silver trade in tandem against or with the gold price. So when they start to show relative strength, that's what happened in late 2022. Both silver and the miners started to show relative strength to the gold price, and that was the hint that the move was over to the downside, and the move to the upside was going to begin. And sure enough, that's what happened. So take a look at and watch the miners in silver, and when they start to show relative strength to the gold price, that's a really good sign for the sector to become bullish again.
So have you been deploying capital in silver, or are you waiting for that signal?
I did. I had a stake bid in one of my top 10 stocks in my newsletter is a silver developer, and I had a stake bid in it that I never thought would get filled. And it did on the last rebalance Friday a couple of weeks ago. VanEck finished their rebalancing on June 17th. June 23rd. It's began on the 17th. This is the week of the 17th to the 23rd, I believe it was. And you saw a lot of fishing lines in many silver juniors because of that. And when you see, this is why you really have to do your due diligence in this sector. When you find out things like that, and the reasons for these sell-offs, when you take a look, because these sell-offs were taking place while gold and silver were trading sideways above 1950. And all of a sudden, quality juniors were being hit hard, and people were wondering, what's going on?
Mhm.
That's what was going on. And when you know these things, it gives you the confidence to buy these fishing lines because you know that once that seller's gone, the stock is going to bounce. Sure
I
thing, it
couldn't
did. It bounced 20% on the following Monday.
I couldn't agree more. Jordo and I were talking about it last week on this very podcast. We were talking about companies like Aber Plata and companies like Dolly Varden for that very reason, the fact that they were just simply getting oversold and trading for pennies on the dollar.
Right. They were part of that rebalance. That what they did was they sold the bottom 20 stocks in the SILJ are the actual juniors, right? With the rest of the index made up of mid-tiers and majors.
Right.
So what they do is they rebalance, sold them out, and added to the other ones. And they came up with a new plan for the GDXJ, and I'm not sure if it's also for the SILJ, but I know it's the GDXJ, where they're going to overweight the top 5 names. So in GDXJ, the top name is going to have 7%, 6.5, 6, 5.55, all the way down, right? So they're going to rebalance now only twice a year, every June and every December in GDXJ, and I imagine SILJ. So so you mark that on your calendar for December this year. That's when the next rebalance is. So that's when, you have some cash and you wait to see what happens with how many shares are going to get sold, what fishing lines are going to pop up because of this rebalance. Or it could happen on the upside, which is what happened last December. You had a lot of these silver stocks have huge white candles last December when they did a rebalance because it was right after tax loss selling season, right?
Yeah.
So they rebalanced, saw buying was coming into these ETFs, so they had to rebalance.
Mm-hmm. I think that's a pretty good summation of the current state, from technicals on gold to drivers of gold to where we are with valuations of gold stocks. Is there anything we failed to cover or mention that you want to talk about?
Just that now is a great time to do your due diligence. You've got all this time, right? These companies are available. You call them up, you get one-on-one meetings, you ask them the right questions, and it's a great time to get in the best of the best. You don't need to mess around with anything that is suspect right now. You can get the best of the best because
For cheap.
basically the junior minor babies are being thrown out with the lifestyle junior bathwater right now. And you just have to concentrate on the best stocks and do it with cash. Don't do it with a margin account because some of these things can get cheaper. And they'll all bottom on their own account. They won't all bottom at the same time. You won't hear a bell. So you look at valuations, you look at management teams, you look at share structures, you look at jurisdictions they're in. You've got all this time to do this due diligence. Do it, and accumulate ugly charts right now because they're going to be beautiful within the next year or so.
That's right. And if you're incapable or unwilling to do the diligence on your own, that we often tell people, subscribe to a handful of newsletter writers. Right.
That's what we're here for.
Exactly. Subscribe to your letter, subscribe to my letter. You're going to find that the cream rises to the top, and the very best companies are going to be recommended by multiple newsletters, right? So
absolutely,
it behooves you to do that. And so, will I be seeing you in Beaver Creek?
Absolutely. That's my favorite conference. I never miss it.
Awesome. I will be there as well, as we have been for the past several years. And other than Beaver Creek, David, tell people where they can find you.
My website is juniorminorjunky with a y.com. And each week I have a weekly column at Kitco that comes out on Fridays. Sometimes I skip it, like during the summer doldrums here, I'll skip a week every once in a while. But I generally write a column each week on Kitco, and it comes out Friday mornings.
Great. Like I said at the beginning, I love reading that. And so it was a pleasure to have you on. It's been too long, and we'll have to do it again fairly soon. David Erfle, thank you very much for coming on Investing in Bizarro World. This was episode number 225, if you can believe it. And I'm supposed to tell people, Gerardo usually does this, so I got to do it for him too. Go to dailyprofitcycle.com and check out the free editorials we have there. Click like and subscribe, and of course comment and tell us what you like and don't like. Until next week when Gerardo is back, I'm Nick Hodge, and this is Mr. David Erfle, the junior mining junkie.
Junior miner junkie.
Junior
again,
miner
Nick.
junkie. Thank you.
Hey there, you independent-minded investor. If you like this video, make sure to tell us so by clicking the like button below. Subscribe to our channel so you never miss another one. And share it with everyone you know on social media. You can also click the link in the description below to check out more information-packed videos just like this one. Thanks for watching.